If you have $500,000 in your portfolio, you are doing better than 90% of the population. You are doing better than 90% of the population. That's a significant achievement, and you should be proud of your financial discipline. But if you think that $500,000 is enough to quit your job forever and live solely off dividends, you are walking into a mathematical trap. This trap could wipe you out in less than a decade. It's a common misconception, fueled by misleading information online. I know the internet loves those thumbnails that say, make $40K a year on $500K passive income. It looks like the ultimate cheat code. A path to effortless wealth. But the reality is far more complex and often quite dangerous. But there is a massive difference between generating cash flow and actually sustaining a 30-year retirement. It's not just a game of pressing buttons. Today, I am going to show you why the math behind the dividend dream is often a lie, and why chasing that yield might be the single riskiest thing you can do with your life savings. It's time for a reality check to uncover the hidden dangers and equip you with the knowledge to make truly informed financial decisions. In this video, we are going to tear down the income-only fantasy and look at the hard numbers of what it actually takes to quit.
We will look at why the yield trap is so dangerous, and I will show you the alternative strategy, total return investing.
Even if it feels scarier to execute, it's the path to true financial security, not just an illusion of it. Let's dive into the details. Before we dive into the spreadsheets, if you want to stop guessing and start engineering a portfolio that actually survives the real world, do me a favor and subscribe. It is the best return on investment you will get for your time today. Now let's look at the fantasy of the 8% yield. Let's start with the pitch you see on social media. The premise is simple. You save $500,000, you invest it in a portfolio yielding about 8%. And boom, you have $40,000 a year in gross income. That replaces the average salary for many people, especially if you have a paid-off house or live in a low-cost area. And on paper, the arithmetic holds up. 500,000 times 0.08 is $40,000. Simple. You look at that and think, why isn't everyone doing this? It seems like the obvious solution to the rat race. You don't have to sell shares, you don't have to worry about the stock price going down, theoretically, because the check still clears every month. It sounds like the cleanest financial dream in existence. You see headlines promising yearly dividends of $40. Technically, they aren't lying. The math works on a calculator, but calculators don't have to deal with recessions, dividend cuts, or inflation eating your grocery budget. The lie isn't that dividends are fake. The lie is that most people radically underestimate how much capital you actually need to do this safely. A $500,000 dividend portfolio doesn't usually buy freedom. At best, it buys you some options. At worst, it pushes. Here is the reality check. Mainstream global equity yields, think the S&P 500 or a total world stock market fund, usually hover between 1.5 and 2%. Even if you curate a portfolio of high-quality dividend growth companies, the dividend aristocrats that everyone loves, you are usually looking at a yield of 3 to 4%. Let's run those numbers on your $500,000 nest egg. At 3%, your annual income is $15,000. At 4%, it is $20,000. That will-to-will dollar is $1,200 to $1,600 a month. That is nice up on a cop rates gun. It might pay for groceries and utilities, but it is. To get from $20,000 a year to the promised $40,000 a year, you have to double your yield. You have to force the market to pay you twice what a safe asset pays. So how do the YouTubers get to 8, 9, or 10% yields? They stop buying broad pieces of the global economy and start buying risk. To hit those numbers, you have to concentrate your money in very specific, often fragile sectors. We're talking about high-yield real estate. You aren't investing in Apple or Microsoft anymore. You're investing in a mortgage rate that is highly sensitive to interest rates, or a fund that borrows money to buy bonds. You are trading quality for cash flow. The problem is that when you reach for yield, you are often catching a falling knife. A stock usually yields 10% for a reason, because the market thinks the company is in trouble and has priced the stock accordingly. This leads to the yield trap. You buy a stock at $100 because it pays an $8 dividend. You feel like a genius. But over the next year, because the company has no growth prospects or is paying out more cash than it earns, the stock price drifts down to $90. You still get your $8, so you don't panic. The next year, it drifts to $80. After 5 years, your principal is down significantly. Yes, you never sold a share, but your net worth has collapsed. High yields can mask poor underlying performance. Your income might hold up for a while, but your capital is eroding beneath your feet. And if that capital base shrinks enough, eventually, the dividend gets cut too. Then you have no income and no principal. And honestly, capital erosion isn't even the silent killer here. There is something much worse that destroys fixed-income retirees, even if their stocks never go down. If you manage to find a magical 8% yield that stays stable for 20 years, you will still likely go broke.
Why? Because 40 to today buys a lot less than 40 will in 10 years. Most high-yield investments do not grow their payouts. They are flat.
And if your income is flat, your purchasing power is crashing every single year. Let's look at why the safe withdrawal guys sleep better than the dividend-only guys. You have probably heard of the 4% rule. It comes from the Trinity study and decades of retirement research. The rule essentially says that if you have a diversified portfolio of stocks and bonds, you can withdraw 4% of the initial value in year one, and then adjust that dollar amount for inflation every year after that. Historically, in almost every 30-year period, your money would last. But here is the critical distinction that dividend investors miss. The 4% rule is a withdrawal strategy, not an income strategy. It assumes you are willing to sell shares. It assumes that the total return, your dividends plus your price appreciation, will replenish the pot over time. It doesn't care if your portfolio yields 1% or 5%. It cares about the total growth of the bucket. This is where the dividend lie falls apart. The 4% rule is designed to fight inflation. It assumes your withdrawal goes up every year to match the cost of living. A high-yield portfolio stuck at a static payout can't do that easily. To get an 8% yield, you usually have to buy companies that aren't growing. They are paying out all their profits as dividends. If they aren't reinvesting in themselves, they can't grow their earnings. If they can't grow earnings, they can't grow the dividend. So year-by-year inflation eats you alive. This is a critical flaw in the dividend-only approach. The total return investor, however, owns companies that might only pay a 1% dividend, but grow their share price by 7 or 8% a year. They sell a few shares to create their own dividend. This feels risky, but mathematically, it is the only way to keep up with the price of bread. I know why you hate this idea. I talk to investors all the time who say, "Tom, I can't sell shares. If I sell shares, I have fewer shares left. Eventually, I'll run out."
This is the mental block. We view the number of shares as the asset, but the asset is the value of the shares. Think about it this way.
Would you rather own 1,000 shares worth $10 each, or 500 shares worth $40 each? The second pile is worth double the first. Total return investing accepts that your share count might go down over 30 years, but because the remaining shares are worth so much more. The never sell principle mindset is an emotional comfort blanket, not a mathematical necessity. There is another massive advantage to the total return approach: tax control. When you rely solely on dividends, you have no control over your taxable income. If Coca-Cola pays you, you owe taxes, whether you needed that money this month or not. In high-tax jurisdictions, this is a drag on your wealth. When you create your own income by selling shares, you decide when to sell. You can sell specific lots to minimize capital gains. You can choose not to sell if you have cash on hand. You are in the driver's seat. A dividend-only retirements, you are surrendering control for the illusion of safety. Now you might be thinking, okay, Tom, but if the market 40% should be, that is a valid fear. It's called sequence of returns risk. But here's the counterintuitive part. The high-yield portfolio is why? Because in a severe recession, dividends get cut. In 2008, banks and REITs slashed their payouts brutally. So just when the market crashed, the income investors took a 50% pay cut. The total return investor could at least choose to sell bonds or gold or cash reserves instead of stocks. The dividend investor was just helpless. So if $500,000 isn't enough, what is the number? We need to stop looking at yield percentages and start looking at multiples of spending. The standard guidance from research like the Trinity study suggests you need about 25 times your annual spending to be safe. If you need $40,000 a year to survive, the math is simple. $40,000 times 25. That is one day in Doubthives. I know that sounds discouraging. It sounds like I just moved the goalposts a mile down the field. But I'm not doing it to be mean. I'm doing it because I want you to stay retired once you quit. If you try to force $500,000 to generate $40,000 of income, in the history of the stock market, an 8% withdrawal rate has almost a 100% failure rate over long periods. Don't just take my word for it. Simply Safe Dividends, which is a research service dedicated to, you guessed it, safe dividends, suggests a specific formula. They say to take your desired dividend income and multiply it by 22 to 28 to find your portfolio size. If you want $40,000 in safe, growing dividends, they estimate you need between $880,000 and $1.1 million. Why? Because safe yields are around 3 to 4%. If you have $500,000 and you apply a realistic 4% yield, you get $20,000 a year. That is a great side hustle. That is amazing supplemental income. But it is not full financial independence for a standard household in the developed world. This doesn't mean $500,000 is useless. Far from it. We just need to reframe what it buys you. $500,000 is a powerful cost-effing number. It means you could stop saving for retirement entirely, let that money grow in the background for minutes. It buys you the ability to take a lower-stress job that pays half as much. It buys you a barista-fire lifestyle. For a single person practicing geo-arbitrage in Southeast Asia, sure, $500,000 might be full freedom. But for the audience watching this, the danger comes when you try to stretch that milestone into a finish line. When you have $500,000 and you need $40,000, you start making compromises. You stop buying the S&P 500 and start buying that leveraged fund yielding 12%. You ignore the expense ratio. You ignore the fact that the fund has lost value 3 years in a row.
You just stare at the yield. You are effectively taking a portfolio grown into a million real freedom.
It is better to work 3 more years and let the compound interest work than to quit 5 years too early and ruin your capital base.
And this brings us to the biggest tragedy of the dividend obsession. By fixating on income during your accumulation phase, you are likely slowing.
Most people stop here and lose hundreds of thousands of dollars in potential gains because they are addicted to the dopamine hit of a dividend notification. If you are in your 30s or 40s, focusing on yield is arguably the most inefficient way to build wealth. Let's look at the growth engine you are turning off. There is a false dichotomy in investing: growth versus dividends. The reality is that they are just two sides of the same coin. A company makes a profit. It can either send that cash to you, a dividend.
Historically, companies that can reinvest at high rates of return, think Amazon 10 years ago or Google, grow your wealth much faster.
When you demand a 4% dividend yield from your portfolio in your 30s, you are effectively filtering out almost all the high-growth companies in the world. You are betting against innovation. You are telling the market, I don't want the next Apple. I want a utility company that raises prices by 1% a year. Over a 20-year horizon, that decision costs you massive amounts of capital appreciation. The smarter play, endorsed by almost... This means buying the whole haystack, broad market index funds. You get the growth companies, you get the value companies, and you get the dividend payers too. But you aren't tilting toward income. You are tilting toward maximum wealth generation. You reinvest every dividend you get automatically. Your goal isn't cash flow. Your goal is to get your net worth from $0 to $1 million as fast as possible. Growth stocks and broad indices have historically done this faster than high-yield dividend portfolios. Once you hit the big number, so what happens when you retire? Do you have to switch everything to dividends? No, you can keep that total return portfolio. You set up a homemade dividend. You look at your portfolio once a quarter. If you need $10,000 for the next 3 months, you look at your dividends received. Maybe that is $2,000. Then you sell $8,000 worth of shares. Specifically, you sell whatever asset class is up the most. If stocks had a great run, you trim stocks. If stocks are down but bonds are up, you sell bonds. This is a dynamic withdrawal strategy. It allows you to keep the high growth engine running in the background, fighting inflation for you while you siphon off exactly what you need. It is flexible, tax efficient, and historically safer than relying on a board of directors to maintain a high payout ratio. The irony is that dividend investors claim they sleep better at night because of the cash flow, but I would argue the total return investor sleeps better. Why? Because they are diversified. They own thousands of companies across every sector. The high-yield investor is often concentrated in energy. If interest rates spike, their whole portfolio drops. If regulations change, their income drops. The total return investor knows that no matter, they aren't dependent on the health of a specific yield trap. They are betting on human ingenuity and global economic growth. So, is the dividend dream dead? No. Dividends are a beautiful part of investing. Seeing cash hit your account is psychological magic. But the dividend lie, the idea that you can quit capital yields needs to die yields. It is a halfway point. It is a foundation. But if you try to build a skyscraper on a foundation meant for a 2-story house, it will collapse. Real financial independence usually requires a portfolio size of 25 times your spending, invested for total return, not just yield. Here's my advice to you. If you have $500,000, celebrate. You are crushing it. But don't quit your job tomorrow based on a YouTube video promising 8% easy money. Use that money to buy freedom of time. Maybe reduce your hours, switch careers, or take a sabbatical. But keep your portfolio focused on quality and growth. Don't sacrifice your future capital for today's yield. Aim for the real number, that 25 times expenses target. If this reality check was useful, or if you completely disagree and think I'm ignoring the power of covered call ETFs, let me know in the comments. I read them and I want to know your number. Is it 500,000, 1 million, 2 million? Drop your freedom number below so we can see what the real average is. And if you want to see exactly how I structure my own portfolio to balance growth and safety, check out this video right here. Thanks for watching, and I'll see you in the next one. Remember, true financial freedom isn't about chasing high yields. It's about building a robust, diversified portfolio that can withstand. It's about patience, strategic planning, and understanding the fundamental principles of risk and return. Don't fall for the illusion of easy money. Instead, focus on building a strong foundation that will truly support your retirement dreams. Your future self will thank you for it. Take action today, educate yourself, and make choices that align with long-term financial security, not short-term temptations. This is the path to real freedom, a life where you control your finances, not the other way around. Start building your true wealth today. Don't let the allure of quick, high yields distract you from the proven strategies that lead to lasting financial independence. It's a journey, not a sprint. Embrace the power of total return and diversification, and you'll be well on your way to achieving your financial goals. The choice is yours. Choose wisely and secure your future. Thank you for joining me on this important discussion. I hope you found it insightful and empowering. Remember to subscribe for more content that helps you navigate the complexities of personal finance and build a truly secure future. Your financial well-being is in your hands, and with the right knowledge, you can achieve anything. Until next time, keep investing smart and living free. This is Alex, signing off. Wishing you all the best on your financial journey. Goodbye for now. And remember, the most powerful tool in your financial arsenal is knowledge. Keep learning, keep growing, and keep building the future you deserve. Don't let fear or misinformation dictate your financial decisions. Empower yourself with facts and proven strategies. The path to financial independence may not always be easy, but it is certainly achievable with the right approach. Stay strong, stay focused, and I'll be here to guide you every step of the way. See you in the next video, where we'll explore even more ways to optimize your wealth. Until then, keep those portfolios growing and your financial dreams alive. This is Alex, signing off. Remember, the journey to financial freedom is a marathon, not a sprint. Patience and consistency are your greatest allies. Stay disciplined, avoid the traps, and you will reach your destination. I'm confident in your ability to succeed. Keep learning, keep growing, and keep building that wealth. See you in the next video for more actionable financial insights. This is Alex, signing off, your guide to a smarter, safer financial future. Until next time, take care. And remember, the best investment you can make is in yourself and your knowledge. Keep that curiosity alive. The world of finance is constantly evolving, and staying informed is key to long-term success. Never stop learning. And I'll be here to bring you the latest insights and strategies to help you thrive. See you soon. This is Alex, signing off, your trusted source for financial wisdom. Until next time, happy investing.
Remember, the journey to financial freedom is a marathon, not a sprint. Patience and consistency are your greatest allies.
Stay disciplined, avoid the traps, and you will reach your destination. I'm confident in your ability to succeed.
Keep learning, keep growing, and keep building that wealth. See you in the next video for more actionable financial insights.
This is Alex, signing off, your trusted source for financial wisdom. Until next time, take care.
And remember, the best investment you can make is in yourself and your knowledge. Keep that curiosity alive. The world of finance is constantly evolving, and staying informed is key to long-term success. Never stop learning. and I'll be here to bring you the latest insights and strategies to help you thrive. See you soon. This is Alex, signing off, your trusted source for financial wisdom. Until next time, happy investing. Remember, the journey to financial freedom is a marathon, not a sprint. Patience and consistency are your greatest allies. Stay disciplined, avoid the traps, and you will reach your destination. I'm confident in your ability to succeed. Keep learning, keep growing, and keep building that wealth. See you in the next video for more actionable financial insights. This is Alex, signing off, your trusted source for financial wisdom. Until next time, take care.
The best investment you can make is in yourself and your knowledge. Keep that curiosity alive.
The world of finance is constantly evolving, and staying informed is key to long-term success. Never stop learning. And I'll be here to bring you the latest insights and strategies to help you thrive. See you soon. This is Alex, signing off, your trusted source for financial wisdom. Until next time, happy investing. Remember, the journey to financial freedom is a marathon, not a sprint. Patience and consistency are your greatest allies. Stay disciplined, avoid the traps, and you will reach your destination. I'm confident in your ability to succeed. Keep learning, keep growing, and keep building that wealth. See you in the next video for more actionable financial insights. This is Alex, signing off, your trusted source for financial wisdom. Until next time, take care. And remember, the best investment you can make is in yourself and your knowledge. Keep that curiosity alive. The world of finance is constantly evolving, and staying informed is key to long-term success. Never stop learning. And I'll be here to bring you the latest insights and strategies to help you thrive. See you soon.
This is Alex, signing off, your trusted source for financial wisdom. Until next time, happy investing.
Remember, the journey to financial freedom is a marathon, not a sprint. Patience and consistency are your greatest allies. Stay disciplined, avoid the traps, and you will reach your destination. I'm confident in your ability to succeed. Keep learning, keep growing, and keep striving for your goals. See you in the next video for more valuable information. This is Alex, signing off, your trusted source for financial wisdom. Until next time, take care. And remember, the best investment you can make is in yourself and your knowledge. Keep that curiosity alive. The world of finance is constantly evolving, and staying informed is key to long-term success. Never stop learning. And I'll be here to bring you the latest insights and strategies to help you thrive. See you soon. This is Alex, signing off, your trusted source for financial wisdom. Until next time, happy investing.